On 8th of March 2022, the London Metal Exchange did something it had never done before. It stopped its own nickel market. $8 billion in trades were cancelled. Here is why. Chinshan Holding Group held a short position estimated at 100 to 300,000 tons across LME and OTC venues. When prices started rising on Russia's invasion of Ukraine, margin calls hit. Forced buying drove the prices further, liquidity providers withdrew. By the morning of 8th of March, the order book wasn't a market anymore. Fewer than 30 lots within 1% of the best ask against a normal level of 820. Spreads of $5,500 per ton. The exchange suspended trading and cancelled $8 billion in trades. Standard models of market failure explain price discontinuities like crashes and spikes within markets that continue to clear. They don't explain what happened in nickel, not just the price spike, but the breakdown of price formation itself. Order book depth near zero, price impact orders of magnitude above normal, spreads at 300 times their typical level. We call this endogenous shutdown, the failure of equilibrium price formation. The model has three frictions. First, leverage. When a trader hits a margin threshold, they're forced to buy regardless of what they believe about fundamental value. Second, opacity. The market maker can see trades, but they can't tell forced buying apart from informed buying. Third, higher order beliefs. Rational traders care about the next period price alongside fundamentals because they may need to liquidate before terminal value is realized. Each friction has its own literature, but the interaction of all three is the gap. Here's the result you'd probably expect. As opacity rises, the probability of finite time shutdown rises with it, from 7% under perfect transparency to 61% under full opacity, 8 times more likely. The relationship is convex. Each contaminated posterior becomes the next period's prior, so distortion compounds. So far, this all confirms intuition. More opacity means more breakdown. The mechanism is simple. The market maker observes buy orders and updates their belief that the asset is worth more. But forced buying carries no information, it's just margin calls. Under opacity, the market maker can't tell the difference. Their posterior drifts away from the truth. Each period's contaminated belief becomes the next period's prior. By period 200 at high opacity, they are at 77% confidence in the high state, when the true state is 0. But here's a surprise. Look at belief contamination at the moment of shutdown. It's non-monotone. There's a dip at omega equals 0.6. At moderate opacity, the market is actually less contaminated when it fails. The same pattern shows in the spread trajectory. At moderate opacity, the spread narrows, widens, then partially corrects, instead of just blowing out. The reason is intuitive once you see it. The market maker holds no private signal. They take the contaminated bid wholesale, but the informed seller has a private signal. When the contaminated bid runs ahead of their reservation, they recognize the bid as overpaying and willingly sell into it. The market maker is being fooled, the informed trader profits. This is exactly what private information is supposed to enable. The closed form sign condition partitions the parameter space into 3 regimes. Under high momentum, opacity destabilizes globally. Corollary A. Under low momentum, an interior interval exists where opacity stabilizes. Corollary B. Near the boundary, as the public belief approaches certainty, opacity again destabilizes. Corollary C. The 2022 trajectory falls in A and C territory, but the regime structure delivers a testable empirical prediction, a non-monotone spread path under moderate opacity that pure adverse selection models can't generate. Joint necessity. Remove higher order beliefs, and shutdown disappears entirely. Remove opacity, and it falls from 29% to 9%. Neither friction alone produces shutdown. What produces it is their interaction with leverage. The 2022 episode is the rare empirical setting where all 3 were present at extreme levels. Finally, this leads us to 2 policy implications. First, transparency policy is regime conditional. The sign flip means uniform disclosure isn't always optimal. Second, OTC disclosure operates directly on the opacity wedge. The Oliver Wyman review found that of the largest shorts, half had OTC components averaging 52%, invisible to the exchange. This is the cleanest lever and the lowest political cost. Thank you for listening to my video, and I hope you found it interesting.